It is 7:43 on a Tuesday morning in Connecticut, and two men with the same net worth on paper are looking at the stock market for completely different reasons. One is a 39-year-old corporate attorney making $310,000 a year checking his brokerage app before work. The other is a 41-year-old warehouse manager in Ohio, scrolling financial headlines on his phone during break. Both are watching the same market. Both are hearing the same news. Both are technically investing, but one is using the market to build long-term leverage. The other is using it like a financial lottery ticket. That difference is where wealth begins to separate in America. Rich Americans do not just have more money in the market, they use the market differently. That is the real divide. The average person enters the market hoping it will rescue them. The wealthy enter the market expecting it to compound them. One uses it emotionally. The other uses it structurally, and that difference changes everything. In America, most people are taught to think about the stock market in moments: a hot stock, a market crash, a big win, a scary headline, a trade, a prediction. Rich people are taught to think about it in systems: ownership, cash flow, tax efficiency, time, risk transfer, positioning. That is why two people can both invest and still get radically different outcomes over 10 years. The average investor often treats the market like an opportunity to make money fast. Rich Americans treat it like infrastructure. They do not ask how much they can make this month. They ask how efficiently they can deploy capital over the next decade. That sounds subtle, but it is one of the biggest financial mindset differences in America. The average person wants the market to create income. The wealthy use it to create optionality. One is trying to escape pressure. The other is trying to increase control. That is why rich people often appear calmer in volatility. They are not reacting to noise the same way because they are not using the market for emotional survival. They are using it for strategic expansion. And before we break down exactly how wealthy Americans think differently about investing and why it compounds into entirely different lives, hit like, subscribe, and follow Andrew Finance, because this channel is built for people who want to understand how money actually behaves behind the surface. The stock market is not just where wealth grows, it is where financial psychology gets exposed. And rich Americans win there differently because they are not just investing more, they are thinking differently long before they ever buy.
Rich Americans use the market differently because they do not enter it looking for excitement. They enter it looking for efficiency. That is the first major difference. The average investor often approaches the market emotionally. They want action, they want momentum, they want a stock that feels like progress. That is why average investors chase headlines, buy stories, react to fear, and confuse movement with strategy. Wealthy investors usually do the opposite. They treat the market like a capital allocation system. Every dollar has a job. Every position has a reason. Every decision is filtered through one question: is this the most efficient place for this money to go right now? That is how rich Americans think. The market is not entertainment. It is deployment. This changes what they buy, how long they hold, and why they enter at all. Average investors often buy what feels exciting. Wealthy investors buy what fits. Fit matters more than hype. Does the asset match their tax strategy, risk tolerance, liquidity needs, and long-term objective? That is how money gets managed differently at higher levels. The wealthy are rarely asking what stock will explode next. They are asking what allocation increases the probability of compounding with the least unnecessary friction. That mindset removes a lot of the behavior that destroys average investors. Less overtrading, less panic, less prediction addiction. Rich Americans are not trying to win every month. They are trying to structure outcomes over time. That is why they often look boring from the outside. Broad index exposure, quality businesses, tax-advantaged accounts, long holding periods, strategic rebalancing. None of that feels exciting. That is the point. Wealth compounds better when emotion is removed from the process. This is also why wealthy investors care less about market noise and more about market function. Volatility is not automatically danger to them. It is often repricing, opportunity, or tax positioning. Average investors see drops and feel fear. Wealthy investors often see discounts, loss harvesting, or reallocation windows. Same market, different interpretation. And interpretation shapes behavior. That is what separates outcomes. Rich Americans are not just calmer because they have more money. They are calmer because their relationship with the market is less emotional, less reactive, and far more intentional. They are not trying to be impressed by the market. They are trying to use it efficiently.
Wealthy Americans also use the market differently because they understand that taxes, not returns, quietly decide how much wealth actually stays theirs. This is where the biggest gap often hides. Average investors obsess over what they made. Rich investors obsess over what they kept. That sounds simple, but it changes almost every decision. The average investor buys and sells with little thought beyond gain. The wealthy think in after-tax outcomes. They care where the asset is held, when gains are realized, how losses are used, and what type of income the investment creates. To the average investor, a return is a return. To the wealthy, a return is only useful after taxes, fees, and friction are accounted for. That is why rich Americans do not just invest in assets. They invest through structures, retirement accounts, trusts, tax-advantaged vehicles, asset location strategies, municipal bonds for certain income, long-term capital gains instead of constant short-term turnover. They understand that the market rewards discipline, but the tax code rewards structure. And over decades, structure compounds just as hard as returns do. This is one of the least discussed reasons wealthy people keep wealth more efficiently. They are not simply earning more in the market, they are leaking less on the way out. The average investor often focuses only on what to buy. Wealthy investors focus just as much on where to hold it and when to move it. That reduces drag, and in long-term investing, drag is expensive. Taxes, fees, emotional mistakes, and poor timing quietly erode more wealth than most people realize. Rich Americans spend enormous energy reducing that erosion. That is why they often seem less focused on finding the next big winner. They know wealth is built as much through protection as growth. This is also why they think in decades, not headlines. The average investor wants validation quickly. The wealthy want efficiency repeatedly. One is chasing performance, the other is preserving compounding, and preservation is what makes wealth durable. Rich Americans understand that building wealth is not only about earning strong returns, it is about designing a system where more of those returns survive long enough to become real financial power. That is how the market starts working differently when your goal is not just making money, but keeping it and scaling it. The final difference is that rich Americans do not use the market to feel hopeful. They use it to become harder to control. That is what wealth in the market really buys at higher levels. Not excitement, not status, not even just higher returns. It buys optionality. That is the word most average investors miss. Rich people use the market to create choices. The ability to leave a bad job without panic. The ability to wait during downturns without selling. The ability to fund opportunities without borrowing. The ability to think longer because immediate survival is no longer dictating every decision. That is how the wealthy use markets differently. They are not just trying to grow money, they are trying to reduce dependence. And that shifts everything. The average investor often enters the market hoping it will solve pressure. The wealthy enter the market trying to eliminate future pressure entirely. That is why their behavior looks slower, calmer, and less emotional. They are not looking for financial adrenaline. They are building financial independence through ownership. A 44-year-old executive in Boston is not buying index funds because it feels exciting. He is buying future flexibility. A 37-year-old business owner in Texas is not allocating cash into the market because she loves volatility. She is building a capital base that reduces future reliance on earned income alone. That is the real purpose. Rich Americans use the market to make employment less necessary, not just to make returns look bigger. This is the psychological difference underneath all of it. Average investors often see the market as a chance to make money. Wealthy investors see it as a tool to buy freedom, time, leverage, and negotiating power. Same market, different purpose. And purpose shapes behavior more than strategy ever will. If your goal is quick excitement, you will trade emotionally. If your goal is long-term control, you will invest differently. That is why rich Americans keep getting different outcomes from the same market everyone else has access to. They are not just using more capital, they are using the market with a different objective entirely.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.